Welcome to BNN Bloomberg Market Call tonight, everyone. I'm Anita Sharma. My special guest, Jeff Olin. He's the president and CEO at Vision Capital, taking your calls, emails, and tweets on real estate. Our number toll-free, 1-855-326-6266. Our email address, marketcall@bnnbloomberg.ca. Our Twitter handle, @Market Call. How have your holidays been, and Happy New Year, Jeff?
Wonderful. Happy New Year to you. Hope
Thank
it's a
you.
healthy and prosperous year for you and your viewers.
And our viewers. Yeah,
Absolutely.
they're like family. They're like family. You've done market
Absolutely.
calls several times. How are you feeling about the market moving ahead? And just so you know, this viewership that we have, they're very strong, as you know, on real estate. So what's the outlook appearing to be for you from your vantage point?
We feel pretty constructive.
Yeah.
I mean, we are a long short fund, so we don't have to rely on being bulls for real estate to do well at Vision. But we are pretty constructive. We see most property types in most geographic regions, supply and demand is in balance. And that is our blood. It's not location, location, location.
Right.
It's not industry. It's not interest rates. It's like any other industry or business. It's supply and demand. And say most property types in North America, most geographic regions are solid. And the bigger picture scenario, we see more constructive. I mean, a year ago we had Brexit.
Yeah.
A little better, or a lot better, at least more stable. We saw free trade up in the air between Canada, U.S. and Mexico. That's been resolved. We saw a lot of scare trade wars. It ain't over, but it's better.
Phase one signed today?
Yeah, I mean, we saw our wonderful Prime Minister's sole economic panacea was getting marijuana to Canadians, not our energy to world markets. It seems like he's now got a little bit broader effort in terms of the economy. So we see less risk today than we see a year ago, and the real estate markets are pretty solid. So we're pretty constructive.
Okay, so this isn't an either-or situation, right, where we're seeing equities once again bump higher. What a strong year in 2019 for equities. REITs seemed rather lackluster, to use your word, maybe a bit of weakness, but you think weakness is a bit of a temporary situation as far as REITs and REITs
That was
go?
December. For the year, REITs were very strong last year. 2019 was a very strong year.
Everybody was putting money everywhere, it seems.
It was a very solid year for REITs. We had an outstanding year at Vision, over 20% return, and we only had 45% exposure to the market. So that's, was a really solid year for us. Our job is to pick those property types in those geographic regions which will outperform. And so today we like rental apartments, Sunbelt the U.S., value-add players in Canada. We like industrial real estate globally. All the pain in retail is benefiting industrial, logistics, e-commerce related real estate. Those are the two big asset classes we like, and we're cautious on retail because of what's going on in retail.
What's going on in retail? Now we know the whole Amazon situation. Listen, we got to talk a little bit because so much of our concentration is in Vancouver and Toronto viewership-wise. I'd be remiss if you didn't just give us a minute, Jeff, on what you see transpiring with respect to the real estate markets in these two key areas. Today, getting news, probably not breaking news for you, dwindling supply, prices pushing higher. Your thoughts? Yeah,
I mean, there's land constraints in both Vancouver and Toronto, particularly for single-family residential. So it's not a surprise that single-family residential home values are going up. You do have less of a constraint in going up in terms of condos, but again, not a surprise when you have such limited availability in single-family residential, and affordability is an issue that you're seeing bolstering in the condo market as well. You couple that with 350,000 immigrants coming to this country a year. That's a big number. It's interesting to compare it to the United States. The United States has the lowest population growth in 100 years.
Wow.
And Canada has the highest population growth it's had in 4 decades. So there's a big contrast.
But the absolute numbers are astoundingly different too, right? What is it?
Big, well, again,
400 million people versus what, 30, 40 million?
Yeah, so the 10-to-1 factor U.S. and Canada is no longer the number. It's now 8.5 to 1.
Yeah.
And when you got 350,000 immigrants coming to this country, and that's the official statistics, what people don't talk about is you have 750,000 foreign students coming that are renting as well, that is providing a lot of demand to rental apartments, which is why we like that sector very much.
Okay, and very quickly, bullish on 2020 as far as the REIT space goes?
Yeah, I mean, it depends on your property type and geographic region, where some sectors were bearish and some were bullish, and that's why we make a living.
There you go. Well, we're going to find out. We're going to do a deep dive into some of these geographical locations, courtesy of our viewers' questions. So we're going to get to them after this break. Jeff, thank you so much for coming here on Market Call tonight. Jeff Olin is the president and CEO at Vision Capital. We're on real estate. Get your calls in, 1-855-326-6266. Welcome back to Market Call tonight. We are with Jeff Olin. Jeff, let's start with an email from Kathy in Brighton, Ontario. Slate Office REIT, your outlook for this particular REIT, she would like to know.
Slate is managed, Slate Office REIT is managed by an external manager. The managers are extremely competent. Blair and Brady Welch are the principals there. But we're not a fan of this REIT because Brady and Blair and the team there are extremely competent. They have a number of different vehicles, and this is externally managed. It's laden with external management fees, which incents this REIT partially to grow, not necessarily grow profitably. They have private funds they manage. They have public funds they manage. And we prefer internally managed REITs than externally managed REITs because you have better alignment.
Okay, Jeff, thank you. Ready to get to the phones?
Sure.
All right, let's do it. Let's bring in Stephen from Calgary, Alberta. Hi, Stephen.
Hi there, Anita. First-rate show.
Thank you, sir.
Jeff, I wanted to get your thoughts on InterRent REIT. It's clear that you like the apartment sector. Is InterRent in the right neighborhoods to take advantage of falling vacancy rates and higher rents? Many thanks.
Thanks for your question, Stephen. We love InterRent, not only in the right neighborhoods, as you put it. Specifically, they're in Ottawa, Montreal, Southern Ontario, GTA area. So some pretty strong areas in terms of population growth, in terms of where the immigrants are coming. But their strategy is value add. So, these guys don't buy coupon clipping apartments. They buy apartments that are undermanaged physically or operationally. They put in capital. They fix them up. They improve the resident base. And through that process of improving the living environment, they're able to increase rents. They've been doing this for a long time. There's a lot of alignment here. We talked about alignment last question.
That's right.
Between the management and the ownership. This is a darling. We've owned it for a number of years. We continue to like InterRent. It is a growth vehicle. They recently entered into a joint venture with Brookfield to develop some lands around Burlington, around the new transit center there. And so this is a great long-term hold.
Okay, thank you for that. This has got to be a first. It's a first for me. We're going to Los Cabos, Mexico, for our next call, where Glenn is standing by. Hi, Glenn. Why are you watching Market Call? Should be on the beach.
Good evening. Well, it was only 25 degrees Celsius here today, but I'm not complaining.
Good for you.
Jeff, for Morgar,
Yes.
what pre-tax NAV value would you put on Morguard today? And what do you think Ray Saeed's exit game plan will be eventually? I know that Sam Pollock sits on the board of Ray's golf course in Empire. I would appreciate your comments.
Sure.
Thanks.
So Morguard, your question with pre-tax net asset value, it's got to be at least $300 per share. This was a core holding for Vision for many years. We owned it for 5 years or more. It's around $200. To your question, net asset value $300. Why don't we own it anymore? This has always traded at a discount and will continue to trade at a discount because there's, Ray Sahi, as you highlighted, owns 50% of it. Ray is very shrewd. He's also very unpredictable. And he doesn't kowtow to capital markets. He doesn't kowtow to shareholders. And more directly, we sold it because we're not particularly constructive on office or retail, and they have a lot of office space and retail, particularly retail, some challenging retail. Bramley City Center, for example, which,
right.
Regional malls that are struggling. And so we sold it. There's great long-term value there. It's not particularly liquid. There's a de minimis dividend there. We think there's, notwithstanding the discount and a long-term value, in the short term, there's probably better places to place your money.
All right, let's see what you think about this next one before we head to break. Thank you for that, Jeff. We'll get to Joe in Montreal. Hey, Joe.
Good evening. I want to ask your guests about the European residential real estate investment, symbol ERE.UN.
Okay.
It seems like it's a nice big holdings that they have. And I want to know if he's familiar with this one, if he holds it, and would that be a good place to put for out of Canada real estate income? Thank you.
All right, thank you.
Thanks for your question. We know this situation extremely well.
Okay.
My colleague and I were over in the Netherlands in June touring this. They are focused exclusively on apartments in the Netherlands. What I learned, and it may be a surprise to some of your viewers, is the Netherlands is the third most densely populated country on the planet. And there is no institutional, there's no institutional player focused on the apartment sector in that marketplace. It is sponsored by and managed by CAPREIT, Canadian Apartment Properties REIT, which is a granddaddy and the largest Canadian REIT. They have an outstanding team there. You can buy the spread between what they can buy apartments at, call it 4%, and what they can finance in Europe below 1%. Is compelling.
Yeah.
This is a core holding for us. We have a lot of promise for there. There was an equity issue around the current market price recently. We participated that in a big way, and I think you're going to hear big things from ERE. Is a symbol over the medium to long term.
Okay, thank you so much for that, Jeff. Let's take a break. We'll come back and chat more about real estate. You're watching Market Call tonight, 1-855-326-6266. Welcome back to Market Call tonight. We're with Jeff Olin. Jeff, let's get back to the phones. We'll bring in Jerome from White Rock, BC. Hi, Jerome.
Hi, Anita. Thank you for taking my call.
You bet.
My question would be about Brookfield Property Partners.
Okay.
They just signed an agreement yesterday with Allied Esports to develop some kiosks within their mall. So just wondering what you guys think about them in general, and also if he thinks Brookfield Asset Management might be going into an Olympia and York situation. Thank you.
Thanks, Jerome.
So Brookfield Property Partners, there's no question that it is deep value. The net asset value is probably, if you have the Canadian ticker up there, the trades in Canadian US dollars, I'm more familiar with the US numbers.
Okay, we can bring up the US.
It's around $18.50, $19 US. And we think the net asset value is probably around $27, $28 US. So it is deep value, but it has been deep value for many years. And we don't see any predictable catalyst to service that value. When it was established, Bruce Flatt, who's extremely shrewd, said if it doesn't work, we'll do something about it. Well, some investors and unit holders, their patience has run out. It is challenged because they have a lot of retail, a lot of high-end malls. They bought GGP last year, which was an S&P 500 corporation. Some have questioned that move. They brought it pretty well, but they're challenged with that in terms of the perception of Brookfield Property Partners. They have office buildings in London, office buildings in New York City, not a bad asset class. They've done some great developments, but they're externally managed by Brookfield Asset Management. There's not great governance here. It's a Bermuda limited partnership, so there's Americans that won't buy it. It's not on the radar screen because it's mixed use. A lot of non-Canadian investors like pure play investment vehicles.
Right.
We think you'd be better off buying Brookfield Asset Management, which is the beneficiary of the external management contract, owns half of Brookfield Property Partners, and now you're invested alongside where the smartest guys in the room at Brookfield are invested at the parent level. And so, you know, nice dividend, probably a value trap until the guys at Brookfield decide they're going to do something about that undervalue, which could happen. And so there could be a surprise M&A move, but it's been going on for a number of years and you haven't had much return on that investment.
So bypass BPY and just go straight to BAM.
Correct.
Okay, thank you for that. Jeff, let's get to Joy in Markham, Ontario. Hi, Joy.
Good afternoon. Thank you both for taking my call.
Of course.
My question is on Artis REIT. I bought that some time back, and I'm underwater on this one.
Oh, no.
I'm just wondering whether it's worth holding on to it, or should I sell and move on? And are the dividends safe? I'll hang up and listen.
Joy, what did you get in at? What's your average cost?
It was around $28 or $29, something like that.
Okay, let's see what Jeff thinks about that. Thank you, Joy.
Sorry, I don't think it was that high. I don't think it's ever traded close to that. So you're probably better off than you think. It's an artist, again, very strong management, internalized. You know, Armin Martin's very shrewd. The family's very shrewd, veterans in real estate. They've been kowtowing, in our opinion, too long to capital markets. Again, it's a diversified REIT, which many investors don't like. They don't want office, industrial, residential in one entity. I mean, Canadians don't mind it. Canadian retail investors don't mind it. But a lot of the major institutions that at the margin can make the difference don't like it. So they've had a lot of exposure to Alberta. They still have exposure there. They've been selling it down. That's still an issue. They have some exposure in the U.S., which is decent. It's okay. There's been some activism there. Again, we think management is trying to be too responsive to the activism. Manage the business. Get on with your business. You're smart folks. Don't pay too much attention to Bay Street. There's better names. We're not big on the asset classes that Artist has today.
Yeah, the highest that I can see so far is about $17.
Right.
So it can't be that bad to your point.
Right. So Joy, you're not as bad as you think.
There you go. There you go. Let's bring in John from Peterborough, Ontario. Hi, John.
Hey, how are you guys tonight?
Doing okay. How are you?
Great show. Finally got to some REITs. we don't get them very often.
No, we don't. That's why Jeff's here.
I currently hold Summit Industrial. But I'm looking for some other REITs as a defensive play. And I'm looking for something in the dividend category that's going to make me some income.
Okay, well, if you're looking for defensive and you're looking for a dividend, a good name for you would be Sienna. Sienna is in nursing homes and retirement homes. They have a significant presence in nursing homes in Ontario, where there's a shortage of 35,000 beds right now. And they have retirement homes in BC, and they have them in Ontario. Very strong management, good dividend out there today. We think that the Ontario government will finally come up with a formula this year, probably middle of the year, that helps deals with this shortage, and folks like Sienna and Chartwell, another good name, that have a lot of C nursing homes that have not had a funding formula from the government for years, despite this shortage, to justify building new nursing homes. We think this government will finally get it right and provide a formula that allows that. That's a growth opportunity for Sienna on top of the current organic and external growth opportunities they have to unlock some value from the prime locations. And in the meantime, it's very defensive. You can sleep at night knowing that, what's one of the biggest real estate decisions? Tell me about the credit quality of the tenant.
Right.
Well, Ontario government is basically your tenant. So that's pretty good.
Yeah.
Supply and demand, 35,000 shortage of beds. That's pretty good. Solid management. This would be a good name to serve your criteria.
Why do you think the government's going to get it right?
Because they have to.
Yeah.
They have to. There's a shortage. They have to. They can't. They got to get them out of hospitals.
Yeah.
Because that's more expensive.
Okay, Jeff, thank you so much. Time for another break here. We'll come back with Jeff Olin's past picks on Market Call tonight. All right, welcome back to Market Call tonight. We're with Jeff Olin. All right, had our viewers purchased Americold Realty Trust when they have a great ticker, Cold, on NYSE. If they purchased this end of July, they would have made 7%.
Yeah, we'll talk about this again, I think, a little bit later, but there's not very many real estate companies globally, REITs globally, that have what is known in investing circles as a moat. A completely defensive position. Americold has a moat. This is temperature-controlled warehouses. They're the largest player in the world in the capital markets. It's about a $7 billion market cap, New York Stock Exchange. We love this. The management is outstanding. That you can buy these facilities because of the very specialized nature and the heavy equipments at higher returns, higher cap rates, to use the REIT lingo, higher returns than you can other industrial real estate, which is the hottest asset class globally. You look what Blackstone is doing, buying up all these industrial properties. Yeah. Well, you can't just buy a temperature-controlled warehouse without having really great operating. And so it's mission-critical real estate for their customers. The advent of fresh food is helping, and so we continue to like this. It's done well, and we think it's really early. Okay, and you kind of gave it away. You can maybe give it some more color in the top picks segment of our show when Jeff tells you why you should hold on to it. Let's get to Canadian apartment rate. This one, a clear winner, outperforming the REIT index, up 14%. More room for this to grow? Yeah, for some of the reasons we talked about earlier. I mean, they are the oldest and biggest REIT. They have outstanding management. Mark Kinney and his team, they're outstanding. They're diversified. They do have an ownership position in European REIT we talked about earlier, as well as the only Irish apartment REIT. So they have some global diversification. It's small. It doesn't really move the needle. But they have, within their existing apartments, which they have across the country, they have conservatively 10,000 new apartment units they can build on land that they already have. Wow. You couple that with what we talked about is immigration. The lowest vacancy rates in North America, if not globally, for apartments are in Canada. A very powerful demographic, secular factors driving this. What do I mean? Millennials. Millennials want to live downtown. They want to walk to work. They want to go to restaurants. They want the latest iPhone. Lifestyle is trumping the need or affordability of buying a house. And then the other end of the age spectrum, you have baby boomers. Right. Turning 75 in 2021, they're transitioning from home ownership to rental apartments. And so we see very powerful demographic and secular support for rental apartments, and CapREIT is a great name and a great performer. I can't remember the name of the demographer, maybe David Foote. Yes. Was it David Foote? Yes. Decades ago when he predicted this, and he's a couple of decades late. But what he was predicting about baby boomers and whatnot is now transpiring. Baby boomers of the past were not interested in leaving their homes, right? But now you're finding it more and more. They're wanting that condo lifestyle. They're wanting that apartment. And in the Canadian space, downtown, the urban flavor, right? That's a global trend, yes. Yeah, it's a global trend? Okay, let's round this out with the Howard Hughes Corporation. This one underwater, off by about 8%. What's going on here? So in June, Howard Hughes, firstly, we think it's worth around $175 a share. Okay. What we like about it and why it's trading in that discount, it's a corporation, not a REIT, so it's not in REIT indices. They pay no dividend, so it's not in any dividend indices. It's completely self-funding. They never need to raise equity capital, so they don't have the research coverage because they don't generate corporate finance fees for investment dealers. Outstanding world-class assets. Because of the undervaluation, in June, just before my appearance in July, they announced a strategic review. Bill Ackman from Pershing Square is the chairman. He was a meaningful shareholder at the time. That strategic, on the speculation of the company being sold, a lot of investors to try to get that pop ran into the stock post-June. That inflated the stock. It went from about $105 to $135 in September. They announced the culmination of that effort. They didn't sell the company. They took $50 million a year out of overhead, and everybody that bought it for that bump dumped the stock. It's recovered about 80% of that. Okay, so you're still holding on. Yes. All right, Jeff, thank you so much for this. We'll come back with Jeff Olin
President and CEO at Vision Capital. Back to your phone calls next, 1-855-326-6266. Welcome back. We're with Jeff Olin. All right, let's get back to the phones. Bring in Michael from Vancouver. Hey, Michael.
Hello, Anita. Hello, Jeff.
Hi.
Jeff, thank you so much for taking my call. Jeff, this question may sound redundant based on your past picks and some of your comments already, but I'm looking for a similar global REIT to the Canadian apartment REIT, either in the U.S. and in Europe, and you already had mentioned ERE, and I just wondered if you had another recommendation. Thank you so much for taking my call. I'll hang up and listen to your response. Thank you.
Thanks, Michael.
Thank you for your call and question, Michael. Again, if you're looking specific to residential, I don't think you were that dedicated to residential. ERE is a good one. Firstly, it's listed here. So you get all of those benefits of your objective in European real estate by something on the Toronto Stock Exchange where you know what the governance is, you have liquidity, et cetera. So that would be a good name. In terms of a U.S. name, you can buy U.S. names, U.S. real estate, I should say, that are listed in Canada, like ERE is. So one of them is BSR REIT in the residential space. We like that a lot. We talked about Americold. That would be another great name. And now Americold is primarily in the U.S., but they're a little bit in Canada, Australia, New Zealand, Argentina. So you get some of that globalist perspective with Americold, COLD on the New York Stock Exchange. Kennedy Wilson is another great name, worth $28 a share, trading at $22.50. Buying real estate cheaper in the stock market than the property market. Outstanding management. They operate in the United States, selectively in Europe. Great recyclers of capital. That's a great one as well. And Kennedy Wilson, KW, is a symbol there.
Okay, thank you very much for that. Jeff, let's get to Peter in Vancouver. Hi, Peter.
Hi, thank you for taking my call.
Thanks, Peter.
Great show. Great host. The wonderful and very smart Anita.
Thank you, Peter.
Great guest, Jeffrey, who is great in the REIT. So I want to appreciate your previous topic, BSR. It went up sharply when you pick it, then it came down. And today, before you come on the show, it went up 2%. Anyway, may I ask you about HR.UN? Thank you.
Thanks, Peter. Did you do something about that?
The whole sector was up today. So, it was a very strong day for REITs, and BSR went along that ride, although we like it a lot. H&R REIT, is a large cap. Again, it's one of the granddaddies in the Canadian REIT space. Solid management. They've struggled because they're one of those diversified REITs. They're in a little bit of a number of things. They have retail, which has struggled in secondary malls in Canada.
Calgary too, right?
They have some office buildings in Calgary. Excuse me, which, even though they have long-term leases in place, people are already starting to underwriting what happens, looking out 10 years when some of those leases expire.
Well, what about, I think, and Canada was under them, right?
Correct.
Or Optimative, whatever
Exactly
it's called now.
correct. Exactly correct. So they have some exposure there. They have exposure here in Toronto with retail. They do have some attractive apartments in the U.S., but that's small. They have retail, single-tenant retail in the United States, which is not a favorite asset class. And so it's large, it's challenged. They've been talking about doing strategic things to fix this for some time. It hasn't happened. We don't love the assets that they're in terms of the property types, but it's safe. It's safe. The dividend, we think, is solid.
Okay, thanks, Jeff. One more call before we head to break. Carrie in Toronto. Hi, Carrie.
Thank you for taking my call.
You bet.
Jeff, I appreciate your response to this question with regards to portfolio construction. I currently own property and wondering if I should consider that when I'm purchasing REITs for my portfolio. What percentage of REITs should I have in a balanced, diversified portfolio?
You know, what you're seeing globally is institutional and family office investors increasing their allocation to real estate. You know, it was 5 to 10 to 15 to 20%. So probably 20% is a decent number overall. There are significant differences, and we would submit. I used to be in direct properties. I was with Olympia, New York. I was with Bramley. There are millions and millions of folks doing that. In terms of public markets, some of the advantages you get, one is liquidity. You don't have liquidity in your properties. No. 2, you can get geographic diversification. 3, you get property type diversification outside of, buying apartments. 4, you get professional management.
You pay for it, though.
5, nobody calls in the middle of the night to fix the heater. And, you have liquidity. And so there are a number of advantages as a diversifier and our mantra is you can buy selectively, you can buy real estate cheaper in the stock market than the property market, and that's what we do. We've talked about a number of these names that are trading well below the value of the real estate. In the property market, why do you want to be the 17th entity that competes against a REIT, an entrepreneur with too much money in his or her genes to buy property in an auction hosted by CBRE Collier when you can get all those attributes in the public market? So we think it's complementary in terms of a diversifier to an overall portfolio construction.
Yeah, especially if your real estate holding is, say, your principal residence in uptown Toronto, REITs are not all the same, right? You might want some access to, I know you're not crazy about it, but the office space or maybe the warehouse space, or to your point, Americold from south of the border. Okay, thanks for that, Jeff. Carrie, thank you so much for your question. Let's take another break and come back with Jeff Olin, President and CEO at Vision Capital. We'll see you in 2 minutes. Thank you very much, Jeff Olin. Welcome back to the program. We'll bring in Tony from Calgary. Hi, Tony.
Hi, thanks for taking my call, Anita.
Thank you.
I'd like to ask Jeff about Beauregard Apartment REIT. He talked about the parent earlier. The apartment REIT, a little bit illiquid, but it's got a nice asset base. What do you think of it? Thanks.
Yeah, I mean, Beauregard REIT, we like the fact that it's in the multifamily rental apartments. We've talked a fair bit about that, so I won't repeat that because it's in the right asset class. It's somewhat challenged by the fact that it is controlled by Morguard Corp, so it doesn't have that control in the marketplace. It does have a diversification. About 43% is in Canada and 57% in the U.S. It has a nice dividend. It's probably worth $22 a share. There's better places for your capital, though, in our view. Some of the names we talked about, InterRent, Cap REIT, BSR REIT. If you're looking for the U.S., that's a better place to be. Okay, thanks, Jeff. Let's get to Mary in Kingston, Ontario. Hi, Mary.
Hi, thank you for taking my call. And I'd like to ask Jeff about Plaza Retail REIT. Thank you very much. I'll hang up. Okay. Bye-bye.
I think everybody's been influenced by Mr. Ray Sahi. This was another investment by Mr. Sahi recently. Plaza REIT, the manager, the CEO, and a major shareholder is Michael Zakuta. Michael is amongst the best in the business in terms of his niche, which is our grocery store, a single tenant, stable lease real estate. Unfortunately, he's in a challenged sector, retail sector, but he's doing a great job. It's reasonable valued. The dividend is solid. We like it. Okay, thank you, Jeff. 2 more calls to go. Donna in Barrie, Ontario. Hi, Donna.
Oh, hi, Anita.
Hi.
Jeff, thank you for taking my call.
You bet.
I'm wondering about WPT REIT for a TFSA for a long hold. Can you do a little bit of a deep dive on it?
Sure.
Thank
WPT, industrial space. We like industrial. We touched on that at the top of the show. It's a great place to be. All the pain from retail, benefiting industrial, logistics, e-commerce related real estate. Gets a check mark there. Management is solid, gets a check mark there. They're in the Midwest. Again, one of those Canadian REITs, all U.S. properties.
Okay.
Midwest United States, some of the challenged markets. We don't see higher growth. We think you'd be better off in Dream Industrial REIT or Summit REIT than WPT at this juncture.
Okay, thank you so much. Final call for the segment. Peter in Beaver Lodge, Alberta. Hi, Peter.
Good evening. Thank you for taking my call.
You bet.
I'd like to pose a bit of a philosophical question. It's rather related to the chap earlier who talked about portfolio design. And my question is that revolves around the purchase of raw land for very long-term holding, partly as an investment and partly as a proxy for bonds in a portfolio. And if one can't find the land, the raw land, at the price you want, then possibly a REIT that specializes in raw land.
Okay.
Thank you very much. I'll listen to your comments.
Thank you, Peter.
So, the billion-dollar question is where? Is it a land-constrained market or not? Certainly, long-term holdings of land have proved to be very profitable for those land locations that are in the right location. As a bond proxy, it's not good. There's no income. And there's expense. So that's not a good bond substitute from that perspective. There's not a lot of land development companies that are in the public realm in Canada. They never really worked. You can get land development home builders in the United States. Howard Hughes Corp, a great land developer. Tricon has part of their operation land development. Those would be two good names. We happen to own them both. That would give you some exposure in that regard. Both great management teams.
Okay, and you'll talk about Tricon in your top picks segment. So let's take another break, another few calls, and then we'll get to your top picks. You're watching Market Calls tonight. Welcome back. Final round of calls. Jeff Olin. Let's get to Doug in Campbell River, BC. Hi, Doug.
Hi there, Anita.
Hi.
Jeff, I owned First Capital when it came out as a corporation, and IPO way back 10, 12 years ago, and I see that it went to a REIT here first of the year. Is that still worth keeping, and what was the reason going from a corporation to a REIT?
Yeah, we like.
Thank you very much.
Thanks, Doug.
Thanks for your question. We like First Capital, notwithstanding we're not positive on retail. We like First Capital a lot, so that's a big statement right there. It's a $4.5 billion market cap. It has a nice 4% dividend yield. They have some of the best retail real estate in Canada. They're in a niche of grocery store and pharmacy-anchored centers, very stable, necessity-based retail as opposed to fashion, outstanding management. The major shareholder, when you came in at a corporation, which is an Israeli public company, is basically gone. They're almost gone from the stock, so some of that overhang is gone. They're converting to a REIT, which is a positive at this juncture. A lot of the tax shield has gone away, and now they're going to have a broader investor base because folks that wouldn't buy them because they're not a REIT and REIT indices can now buy them. I think this is a very stable, good hold and a lot of development upside. They have 24 million square feet of development potential on land they already own. Wow. This is a good name.
Okay, Jeff. So that's a rarity in the retail space for all the reasons that you mentioned.
Yes.
Okay, let's get to Jerry in Toronto. Hi, Jerry.
Hi, Anita, and hi, Jeff. My question for you, Jeff, is on Northview Apartment REIT. I've actually had it for about 2 years and done very well. I'm up about 50%. And I was just wondering what you would think. Should I buy more? Should I hold? Should I trim? Should I sell? What do you think about it from a valuation point of view, and do you own it? Thanks, and I'll listen to your remarks. Thanks.
You're welcome.
Thanks, Jerry.
Again, in the right space, rental apartments, but the wrong entity in our opinion. One of our checklists is governance. The governance is not great here. They have one of their major shareholders that's in the same business, and there's transactions that take place between the REIT and the shareholder who's on the board. That's questionable. They're just challenged. They have not the highest quality real estate. They're way better names than Northview. I would sell Northview and I would buy InterRent, or I'd buy BSR REIT, or I'd buy Cap REIT. There's our Killam Properties. They're great names in Canada, in our view, that this juncture, at this price, you'd be better served with more upside.
All right. Let's squeeze in one more email before we wrap up this portion of the show. David in Toronto is curious about ProRate. What do you think of this, he asks, as a play on the Canadian real estate market?
You know, it's small, it's obscure, it's illiquid, it's in commercial real estate sectors where, again, we're not positive on it. You get a downturn in the REIT sector, the illiquidity in this name is going to be problematic. So we would, if you want to be in commercial real estate, we'd rather see you in some of these bigger names. We talked about First Capital, for example. They're, you know, better names than ProReit. You want to be small cap. We talked about Plaza REIT. That's a better name than ProReit.
All right, Ray Sahi, the Ray Sahi touch there you're talking about.
Ray Sahi's Plaza Corp. I don't know if Ray's going to buy it this year or this decade, but his, you know, he does his homework. For him to buy Plaza REIT is certainly a good testament to their assets and management.
Okay, Jeff, thank you so much. An absolute pleasure, but the show's not over yet. We'll get to Jeff Olin's top picks straight ahead. All right, welcome back. Jeff, top picks time. You talked about this earlier in the program. You're still holding on to Americold.
Yeah, again, this is in the right space, industrial real estate, but a niche that is more defensive. It's not susceptible to new supply because it's very difficult to build a temperature-controlled warehouse unless you're an operator. They're mission critical for their consumers. They're benefiting from the trends to fresh food, ready to eat, increasing demand. They're professionally managed. They're buying these at returns, cap rates well above other industrial real estate. So you get similar growth. You get sort of similar multiples as industrial real estate, but double the growth. And that's as is. We believe, because of the factors I cited, you're going to see a re-rating where the cap rates or the unlevered returns to buy it are going to come down, so values are going to go up for this space. So we think there'll be a secular re-rating in this space as investors increasingly recognize the niche that Americold has.
Okay. Let's get to another stock that you touched on, less so versus Cold. Cold was your past pick and you're hanging on. Tricon.
Tricon, incredible management. Gary Berman and his team, very shrewd, a lot of integrity there. This is a $2 billion Canadian market cap. There's a 2.6% dividend yield. We think it's worth $13.50, and you can buy it around $11 right now. They're in residential real estate, which we like. Really three different parts of it: single-family residential, renting houses in the southern United States. A niche asset class that's evolved in the last couple of years. Starwood and Blackstone have been involved. Tricon's the third player, but not a small one, 20,000 homes. They've also evolved into rental apartments, where they have 7,200 apartment suites in the United States. And they have, earlier question, land development for sale housing development. So they're all in residential, which is where we like folks to be in the United States. High growth markets, great management. Stock is cheap. There was an overhang because they did a big apartment portfolio acquisition, and they issued a ton of stock to retail investors that didn't know what they're getting. So there was some turnover in the stock. You're going to see that recover this year, and we think it's an incredible investment.
Yeah, I know you're a huge fan of the U.S. Sunbelt, and with Tricon in particular, you also get access to the Toronto market, which continues to remain rather strong, right?
These guys' roots were creating value in the Toronto market, and they're still doing it.
There you go. Let's get to BSR REIT, HOM on the TSX. This one, too, a play on U.S. multifamily here?
U.S. apartments in the Sun Belt.
Okay.
Again, misunderstood entity. What we love about this, firstly, management, really smart, really hands-on. They own 50%. We love alignment of interest like that. It's 9,400 apartments in the Sun Belt. They've done a great job recycling their investment from secondary and tertiary markets in Louisiana, in Oklahoma, in Arkansas, to Texas, Dallas, Houston, Austin, Texas. And so today, 50% of their net operating income is from Texas, major centers, going to 70%. So what we like about it, one, it's affordable apartments, like $900 a month rents. So there's upside because these are the highest population growth and job growth locations in North America.
That's not even a basement apartment in Toronto.
Right. So you have the right growth, you have offense, and if we have a decline because you're low rents and affordable apartments, you know, their residents are more, you know, working population folks and low rent. So we like this. We think it's worth $13.50 today. And when you start to get your cap rate, your unlevered return, recognizing they're now in Texas in major centers, not in secondary markets, we think that $13.50 can go $15 to $18 over the next 2 to 3 years.
Okay, well, we're going to find out. Maybe you're going to be back sooner than that, maybe in about a month or so. Jeff, always great to have you on.
Thanks for having me.
Okay, you bet. Jeff Olin, I'm Anita Sharma. As always, please consult a qualified financial advisor before you make any investment decisions. Thank you so much for joining us. I'll see you Monday night. Greg Bunnell will be with you tomorrow night and Friday night. Take it easy.